recently removed a significant impediment for companies seeking to provide crypto asset custodial services by rescinding Staff Accounting Bulletin number 121.
All right, we're live. All right, we're live. You just never know with YouTube. What's up, guys? It is Monday, and I just learned right now in real time that the SEC's fourth crypto roundtable in their series is live right now. I have this up behind us muted. This kind of throws a wrench in my plans, changes it up. Do we want to watch that? There was some pretty good stuff last time. It just started, so maybe we should just catch the beginning. Let me see. I'm going to put a poll up. I'm going to turn his audio on. Give me a sec.
Accommodate crypto assets. Additionally, I've asked the staff to explore whether further guidance or rulemaking may be helpful for enabling the listing and trading of crypto assets on a national securities exchange. While the Commission and its staff work to develop a comprehensive regulatory framework for crypto assets, securities markets participants should not be compelled to go offshore to innovate with blockchain technology. I would like to explore whether conditional exemptive relief would be appropriate for registrants and non-registrants that seek to bring new products and services to market that might not otherwise be compatible with current Commission rules and regulations. So I'm eager to coordinate with colleagues in President Trump's administration and in Congress to make the United States the best place in the world to participate in crypto asset markets. So thank you all for your attention, and I look forward to the discussions to follow, and I really look forward to ideas that may come from you participants here. Thank you very much.
You're welcome very much. Yeah, we didn't know this was live. Thanks for tuning in, guys. Make sure you smash that like button, subscribe button. We won't watch all of this.
Good morning, afternoon, whatever it is.
Warm up. It's afternoon, lady. It's afternoon.
Today's topic is very broad. Perhaps the broadest tackled so far by these crypto task force roundtables. Tokenization. I understand that much of the discussion will focus on potential regulatory efforts to facilitate tokenization. This idea brings to mind a famous line from the movie Field of Dreams. If you build it, they will come. As you may remember, this is a movie starring Kevin Costner as Ray Kinsella, a farmer who was inspired by a mysterious voice to plow under his cornfield and build a baseball diamond, taking it on faith that great things will follow. I see a parallel to the current enthusiasm around tokenization. Blockchain technology has been around for a long time. And although some limited use cases have recently been introduced, it has not been widely adopted for issuance and trading of registered securities. There's a view that if we build, or more accurately rebuild, the financial system to accommodate blockchain, they, all manner of market participants, will come to embrace the tokenized securities. Investors will benefit from increased participation and choice, and markets will flourish from blockchain-derived improvements. To this, I would first ask today, what exactly are we trying to build? What is tokenization? It's a term that, even limited to the SEC space, eludes a straightforward definition. Does tokenization mean issuing a security directly on a blockchain? Or does it refer to creating a digital representation of a security on a blockchain? This may seem a subtle distinction, but it likely carries significant consequences from a regulatory perspective. Beyond issuance, does or should tokenization encompass downstream distribution, trading, clearing, and settlement? In other words, would the entire securities life cycle move on-chain or only part of it? However we might try to answer these definitional questions, it's clear that a tokenized financial system is unlike anything we've seen before. It's not something known or understood like the baseball field Ray Kinsella built. The vision many espouse seems to be a fully tokenized system where any security, including high-volume liquid products like Fortune 500 stocks, can be issued, traded, cleared, and settled on the blockchain. Is that even technologically possible? If we are talking about public permissionless blockchains, the answer, at least as we sit here today, seems to be no. The transaction volume limitations and other scalability problems are well understood. The whole concept of public permissionless blockchains, which were designed to provide trust without the need for government oversight, seems an awkward vehicle for something as complex and statutorily regulated as the securities markets. If we're talking about private or permissioned blockchains, does that improve the potential for scalability? If it does, is this qualitatively different from other types of database technologies already in widespread use? Does it warrant any regulatory adjustments? No one seems to disagree that the SEC should remain a tech-neutral regulator. So why is it our place to assess particular forms of blockchains as candidate for industry adoption? Why would we focus on blockchain in particular over other types of distributed ledger technologies? Regulatory efforts to facilitate adoption of blockchain, let alone specific forms of it, seems a bit like the government picking winners and losers. And we seem to be doing so before the technology has even demonstrated as fit for purpose. Moving on from the questions around what we are trying to build, why are we trying to build it? Proponents argue tokenization can speed up the settlement of trades and make markets more efficient. Instead of our current settlement cycle of T+1, tokenization could potentially move us to an instant settlement of T+0. There's also an argument that instant settlement could replace counterparty risks because the trades would be pre-funded. But the settlement cycle, while shorter than it used to be, is perhaps a design feature, not a bug. The intentional delay built in between trade execution and settlement provides for core market functionalities and protection mechanisms. For example, the settlement cycle facilitates netting. Roughly speaking, netting allows counterparties to settle a day's worth of trades on a net basis rather than trade by trade. The sophisticated multilateral netting that occurs in our national clearance and settlement system drastically reduces the volume of trades requiring final settlement. On average, 98% of trade obligations are eliminated through netting. This allows the current system to handle tremendous volume. It's a key reason why our markets withstood sustained record-breaking trade volume in recent weeks without major failures. Netting also facilitates liquidity. Because the vast majority of trades are netted and don't require settlement, they don't require an exchange of money. If A sells to B, B sells to C, and C sells to A, those trades are paired off and eliminated. A, B, and C can each retain their capital, as compared to a bilateral instant settlement over a blockchain, where each would have to give up its cash for at least some period of time. Another important consideration is that instant settlement would generally disfavor retail investors, many of whom currently rely on the ability to submit payment after placing orders. We must also remember that critical compliance activities take place during the settlement cycle. These include checks designed to identify and prevent fraud and cybercrime. When red flags go up, the ability to pause a transaction and investigate is essential for investor protection and broader concerns like national security and counterterrorism. For these reasons and others, it is not at all clear that shortening the existing settlement cycle in this way is desirable or feasible. Regulators and major market participants here and abroad have persuasively argued otherwise. I think it's our statutory obligation as a regulator to exercise extreme caution with potential changes of this scale, which historically have been undertaken only to address true market crises. While there are certainly areas to improve in our markets and ways we can innovate, I am interested in whether the changes discussed today would fix any existing specific dysfunction. In Field of Dreams, putting faith in "if you build it, they will come" worked out pretty well in the end for Ray Kinsella. But Ray was making a choice and taking a risk limited to his family and his farm. The SEC is the steward of the U.S. capital markets, and the kind of systemic changes that we are talking about have the potential to affect every market participant from Wall Street to Main Street. Let's ensure that what we're contemplating is appropriately scoped to the portion of the market that participates in crypto, recently estimated to be less than 5% of U.S. households, and not detrimental to TradFi markets, on which most Americans depend for their financial well-being. Thank you all for your ongoing engagement with the Commission
welcome.
and your serious discussion of these important issues, and I look forward to the roundtables today. Thank you.
All right, this is the fourth but not final SEC roundtable on crypto. I didn't know this was going on until we went live. I checked my calendar and said, oh shit, I guess we'll cover this. We're not going to watch the whole thing because we have watched the whole things of these, and I'd say about 30 to an hour in, it just gets really cyclical, repetitive. But we have actually heard some really solid statements by some of these panelists. They diverge from maybe like Congress and stuff. What is this guy?
And tokenization is no different. These roundtables serve as an opportunity for financial regulators to seek public
Bad
input
audio.
on how to address new types of financial products and services. We should not shy away from policymaking about emerging technologies simply because it does not fit into the existing regulatory framework. The first step in sound policymaking is seeking input from market participants. In recent history,
All right, this guy's audio is awful. There's a super high pitch ringing. I don't know if you hear it. If you have headphones on, you probably do. He does have subtitles up there. I don't think he's gonna say much. I just hate that audio. But yeah, we have heard these panelists say things that matter in the past. My only kind of thing I don't like about this is that they do talk about stable coins seemingly more than everything else. They almost never talk about Bitcoin. Something that they've already brought up, though, here is WRA, real world asset or tokenizing securities, which is pretty big and actually interesting. So hopefully they touch more on that. Is this guy still going?
with a view to constructing a regulatory framework that provides transparency and predictability for market participants that seek to bring assets on-chain. These conversations are particularly important given the development and deployment of new technologies, which have the potential to dramatically change how financial markets operate. In particular, the developments related to the tokenization of real-world assets using blockchain technology implicate major financial market functions and processes like issuance, trading, transfer, settlement, and record of ownership. In addition to these financial market improvements, tokenization presents opportunities to expand the landscape to demonstrate proof of ownership, making possible new types of uses, such as tokens that represent title of real estate or holdings of intellectual property rights. These implications can potentially benefit investors by enhancing liquidity for otherwise relatively illiquid assets, reducing delays associated with
let's at minimum turn them down,
and also decreasing transactional costs. Additionally, the technology has the potential to simplify, or at least streamline, certain compliance functions, such as through smart contracts for on-chain assets. These potential improvements in capital markets are tied to key characteristics of blockchain technology. Blockchain technology relies on a transparent ledger and does not require a central intermediary. Market transparency impacts transactional costs, but also implicates potential compliance issues, as more opaque and complex markets may increase compliance costs. For example, there are many regulatory questions, challenges the Commission and its staff may need to resolve under the regime established by Regulation NMS as securities move on-chain. As such, we should evaluate whether these technologies can benefit all market participants. In the mid-1980s, then Commissioner Joseph Grunfest described the rapid pace of technological...
All right, I can't. This guy, dude, it's like giving me a headache. It's giving me a headache. I do want to watch more of this, but not this guy. I think this happened last time. He was also speaking, and yet he was like in this weird void bubble. I'm not sure why he's not just there talking. Anyway, let's take a peek here. Bitcoin at 102,009 after trading to 105K today. Big deal, big stuff. We are seeing alts move, which I think is kind of stealing the show here as Bitcoin now pulling back from that 105K, showing us a little volatility. Don't hate what's going on here. Looking for support, some kind of low to hold here around 102. I think that a long could be taken to the all-time high here. This is a hard time in trading again because we have seen just down, just right for months. All of a sudden into May, that has kicked up, and now we're seeing mostly just up. So what do? Right? Do you long after it's going up? That's a really risky place to be. Taking a short, equally risky here, as we've seen very little pullback, very little bearish pressure. It's in a rough spot. Ooh. This is the crypto mom lady. She's usually good.
And thank you especially to the panelists. We're really looking forward to the discussions, and I'll let you get started here relatively quickly. And I appreciate also Chairman Atkins, Commissioner 𝐒𝐈𝐆𝐍,
Sure.
and Commissioner Crenshaw. And Commissioner Crenshaw, thanks for raising some.
Yeah, you're welcome. Lots of thank yous. We will catch hers, but let's go over this while they're thanking. So Bitcoin dominance taking its first little tumble here since December, and alts are enjoying it. We're seeing alts across the board rally. We did discuss that the USD pairs may have already bottomed out for the mid short term on alts, though they may still suffer in the BTC pair, as I don't think that this is done. We haven't hit 66% yet. Nothing says it has to. But I'm still thinking we see higher in this cycle. But for now, your portfolio is probably looking green, probably feeling good. The monthly on dominance now bearish engulfed, or tested the bearish engulf. However, we did see this in November. So be careful here. Don't get too excited with these alts moving. And Crypto Mom speaking again. I know this is such an ADD stream.
Seamless transfer of assets and related data. These protocols commonly rely on cryptography for their operation and security. Novel crypto assets that would not exist but for the underlying protocols live on these networks. So too do traditional assets when they get tokenized. Tokenization fits squarely within the Commission's jurisdiction because it involves formatting traditional assets like stocks and bonds as crypto assets or tokens on a crypto network. Much as earlier internet-based protocols dramatically enhanced our lives by making it easier to communicate and to access information, these cryptographic protocols have the potential to improve our lives through enhanced accessibility and efficiency of the markets for traditional financial assets. Your smartphone makes you smarter and more efficient by serving as a portal to the internet and its network of applications. Similarly, tokenizing traditional assets and putting them on crypto networks makes them smarter. Crypto networks are not only a new type of database or ledger for recording ownership of assets, but also a new type of computing platform that can support applications that allow you to do more with your assets. Smart contracts are self-executing software programs that define important properties of assets and applications running on crypto networks and serve as a portal to the networks of applications supported by these new internet-based protocols. A smart contract can define how and when securities may be purchased, sold, and transferred, as well as automate dividend and interest payments or other distributions. Further, because of the common protocols used to program these smart contracts and the related assets and applications, investors can use tokenized securities seamlessly on or within other smart contract-based applications, including DeFi applications. Removing securities from siloed databases and tokenizing them on open, composable crypto networks mobilizes them and makes them usable in new and enhanced ways. Stablecoins, the first application of tokenization to reach scale, demonstrate the efficiency and accessibility improvements that may arise from the use of crypto networks. Tokenization may provide similar benefits to the securities market, such as increased operational efficiency, transactional transparency, liquidity and accessibility, faster settlement, and greater investor opportunity. Several tokenized money market products are registered already under the Investment Company Act of 1940, and tokenized private funds similarly issue securities designed to maintain a stable value and provide yield. Using crypto networks to maintain the record of ownership enables securities to be used as collateral in derivatives transactions rather than requiring investors to redeem securities and then post cash as collateral. Tokenized securities also may serve as a means of settlement in the purchase and sale of other crypto assets, including other tokenized securities and peer-to-peer or other types of on-chain transactions. If these assets live on the same network, near instant and simultaneous settlement is possible. As Commissioner Crenshaw discussed, there are reasons why that might not always be something that we want, but I think it's a potential that we should be thinking about. Tokenization cannot reach its full potential without legal clarity. Issuers and transfer agents continue to be unsure about whether a crypto network can be the master security holder file or a component thereof for purposes of the Exchange Act's transfer agent's rules, and even where state law has expressly provided or contemplated the use of a crypto network in connection with the maintenance of securities ownership records. Further, the Commission's special purpose broker-dealer statement, which defines crypto asset security to encompass any security that relies on cryptographic protocols, has created confusion regarding a broker-dealer's ability to custody tokenized traditional securities, even when issuers and transfer agents retain control and can address erroneous or impermissible transactions. The Commission proposed to amend the Advisors Act custody rule to preclude traditional securities that are issued on a public permissionless crypto network from eligibility for an exception from the qualified custodian requirement. We're working on providing legal clarity on these and other questions in a sensible manner. Absent a compelling reason grounded in fact and law, the Commission should treat tokenized securities the same as traditionally issued securities. Under this approach, for example, the type of database used to record ownership of securities does not affect the substance of the securities issued, nor does the use of a crypto network give rise to a new or different type of security. A crypto network can constitute all or part of an issuer's books maintained by its transfer agent. Tokenized mutual fund shares and tokenized privately issued securities should be eligible for exceptions for such securities from the Advisors Act custody rules. Tokenization may raise some legal challenges related, for example, to the integration with DeFi, application of the transfer agent rules, and NMS requirements, use of permissionless networks, and appropriate classification as certificated versus uncertificated securities. We can work through these and other issues with the expert help of today's panelists and other interested members of the public. Again, I think the job that we're trying to do as a regulator is to build the regulatory framework and see how experiments happen, whether they happen, and how they develop. And so I'm looking forward to discussion of these issues. Jeff, handing it over to you.
Jeff.
Thank you.
Senor Jeff. We're just catching some of the crypto roundtable from the SEC. We've caught the last few. We're not going to watch the whole thing like we have in the past. They're doing their thank yous. That was Crypto Mom. The Crypto Mom. She usually has good stuff to say. That was a little word salady, a little gibberish feeling. But they really have. They have had some good comments here on these panels. Typically in the first hour, so we're not going to watch the whole thing like we have because it really does just trail off into nothing. But let's see. Anything good here?
First, some level setting, particularly around some key terms and concepts. Second, discussing both the opportunities and the challenges presented by the existing infrastructure as well as our existing body of law and regulation. And then third, some practical advice for the SEC in terms of moving forward. We have, I'm told, until 3:30, so we have actually a little bit of
No, you
extra
don't,
time.
sir. Sir, you do
Just
not
a bit of
have till
housekeeping
3:30.
for our panelists. Go ahead and hit your button whenever you're going to talk and the light will come on. A good place to start, just in terms of a spirit of an optimistic future, if each
That's a good place to
panelist
start.
as a kickoff will just
All right, that's a good place to start. I'm just going to update you on charts in between here. Ethereum versus Bitcoin actually doing well here. 0.018 bouncing. We have talked about this every step of the way. It seems to be behaving actually pretty nicely here. What we want to see, this was where I will completely revert my stance on Ethereum, is Ethereum retaking 0.25 previous resistance, taking it back, holding it as support, and seeing some kind of break of that structure. I'm liking what we're seeing here. This is really the first time FBTC has shown any strength. When you combine that with ETHUSD, I think things look pretty good. 2,500 is definitely the level that we need to be a little bit careful about. A little bit careful, a little bit cautious. 2,500 on a monthly time frame really shows where this resistance is. Let's Take a peek at this. Months and months we spent as support here. Double top, fell lower. This is the scary spot to reject from. 𝐂𝐡𝐚𝐫𝐭 𝐎𝐧 is speaking. Maybe we should listen to 𝐂𝐡𝐚.
De-risk some of the aspects of the market by shortening settlement cycles, not saying T0, but by shortening settlement cycles and improving collateral utility. Our core belief is that we don't have to reinvent the regulatory ontology that serves our market so well. We think there's a strong foundation to build from, and we are encouraged by Commissioner Peirce's comments on May 8th, talking to the opportunity to work within a regulatory sandbox and safe harbor that we think will encourage innovation and draw in pilot programs that we're interested in being a part of. So once again, thank you.
You're welcome, 𝐂𝐡𝐚.
Thank
I don't know what
you,
you're thanking us for, but
to the commission and to
XRP looking
the
good.
commissioners for sponsoring this roundtable today. I am representing the digital asset management unit within Fidelity. Fidelity has long been both a investor as well as a technology research and development arm in this space, looking at blockchains and crypto assets from the standpoint of how we may be able to improve the financial solutions that we develop and offer to our investors to help them manage their financial lives. As we think about how this technology can change the way in which we both develop investment products, but also how it is that we may be able to distribute these products, there are a number of ways in which we see opportunities for being able to produce enhanced financial solutions. First, as we see that moving assets on-chain, there are potential new utilities that we would be able to see traditional assets being able to access that today they're not able to access, such as the ability to move and transfer these assets outside of traditional brokerage hours. You have the ability to transfer these assets in a global capital market across both 24/7 as well as 365-day transfers. This allows for more efficient management of capital balance sheets, and from an investor standpoint, the flow of capital becomes much more efficient. As we think about the opportunity to develop new investment structures through which we may be able to pool investor capital to be able to allocate more efficiently, we also are very encouraged by opportunities to bring assets that are traditionally not easily tradable on-chain to make them more tradable across investment products and solutions that we can develop, which then increases diversification and access for investors across a multitude of assets that they would gain access to. So we look forward to continuing to be able to produce and work with this technology and developing new investment products.
You would.
Good afternoon. Thank you again, Commission, for having.
Oh my God!
this
Stop
panel
thanking each
and,
other. There's
look forward to
literally
an
no
engaging
reason to thank it,
discussion
like
here.
each time.
Calling back to Chairman Atkins' call, I think we're description of where we're at right now. I think moving from cassette to MP3s, I really think where we're at in this inflection point of tokenization is moving from Napster to the Apple iStore, and
Cool.
really can start hitting the beat and have some good music here. So not to beat a dead analogy, but at Superstate, we're seeking to upgrade the capital markets through leveraging tokenization and through care and creativity, helping evolve what we consider the national market system. So, what does this mean? Presently, a vast majority of securities are held in a centralized database that are controlled by a myriad of intermediaries, and that's proven scalable and resilient, but it's also limiting, dated, and creates a central point of failure. At Superstate, we're looking to serve issuers directly as a transfer agent to enable them to facilitate tokenized equities. And through tokenized equities, you're able to have registered ownership, and that enables, as others have alluded to, peer-to-peer transfers, improved collateral treatment, engagement in lending, DeFi, exchange capabilities, and then wholly new opportunities and use cases for investments, given the fact that these securities are now programmable. It's not just utility, though. It's also improved investor protections and compliance capabilities. And so, as a transfer agent, we're able to ensure that the limited opportunity applications that these securities will engage with in DeFi are both resilient and perform as they intend and say they will. Additionally, only eligible investors are able to engage with the securities. Further, as has been alluded to, there will be advancements and more efficiencies in settlement and clearance. And finally, moving corporate governance on-chain will simplify and provide more transparency, so there will no longer be overvoting or undervoting or disputes in who is voting, given the on-chain attributes. Where we see this as being extremely elegant is it does not disrupt the current market structure. It's additive, and it's a choice. If issuers and investors seek and want to engage on-chain, they should have that option, and the technology exists for them to engage. So by engaging with this functionality, we believe capital markets will be able to advance past the ossification of the 1970s market structure and move forward in a less intermediated, more choice-driven, and more competitive environment. We believe this is consistent with how the Commission has previously engaged and leaned into technological advancements, and is also consistent with how America has continued to innovate and be at the forefront. So look forward to an engaging discussion, and thank you for the forum.
Just have the engaging
Thank you. My name
discussion.
is Una
Stop
Choi.
thanking
I'm
each
from
other for it.
NASDAQ,
Just have it.
and I want to echo everybody's thanks to Commissioner Peirce and the Crypto Task Force for talking about this innovation in the context of evolution of the capital markets. And NASDAQ in particular is a reflection of the evolution that has undergone in the financial markets, starting with trading paper certificates to trading electronically to trading wirelessly and now being on the cloud. And within the crypto world, we've been involved in providing ETPs with respect to crypto-based instruments going back to 2015 for the past 10 years through our Stockholm exchange, followed quickly by Ether. And we work closely with both US and European issuers to think about crypto-based exchange products, IBIT being one of them, and with different sort of crypto offerings that could come into the market. And we have been very active in terms of thinking about that in the context also with corporate issuers as well, trying to think creatively about how capital structure can be affected by digital assets and blockchain technology in particular. Within our fintech world, we provide matching engine and data services to crypto platforms across 6 continents. Also provide trading and market surveillance capabilities and technology solutions, sometimes using Gen AI to different participants in the digital assets ecosystem. So beyond sort of the organizational focus, we are very excited about this new technology, both in terms of tokenization of securities, but also in terms of how this can ease the congestion within the system, whether it's collateral management or some of the other aspects that people have talked about already, and also in terms of modernizing proxy plumbing and processes generally. So I look forward to doing a deeper dive with other panelists today.
What? Proxy?
Good afternoon. My name is Christian Sabella, and since I work at DTCC, I'm really excited to be in a room where people are using the words like settlement cycle and netting and
you don't sound
post-trade
excited,
settlement.
bro.
So thank you very much to the commission, the task force staff, and the backbone SEC staff for organizing this sort of event. From where we sit, we do see a mix of evolutionary and revolutionary dynamics going on here. And that may seem a bit odd, given we are sort of the previously referred to kind of incumbent that's sort of there. But one of the things that this has done for us is make our central securities depository business at DTC very interesting and exciting. Not that it never was, but I think more people are appreciating that now. And it's a welcome relief from constantly talking about central counterparties in other contexts. But we've been, I think, working with this new technology for some time now. Folks who have been following us in this space would have seen us doing projects in the past, like Project 𝐈𝐢𝐿, working with basically ledger technologies to see how they do in terms of scaling, and really dealing with the increments, intervals, and frankly, just the overall heft that goes into supporting the premier financial market system in the world on the post-trade settlement side. We've learned a lot from that. We did some strategic acquisitions, and we now have a full-fledged digital asset service, which, again, if you keep track on the socials or otherwise, you would have seen us do a collateral mobility experiment just last month that basically started to showcase the tokenization abilities and potential that we have been developing in-house and are looking to basically explore with market participants as a, again, central industry-owned service provider to basically try to build that.
So I think what's going on here is that they're talking about what they do. These are all private sector people for the most part, even though they're on the SEC's roundtable. They are not like SEC members, which I believe is confusing. But the roundtable members, I don't know. But basically what they're saying, being these private entities, is someone said, should we trust them? They're not trustworthy. I don't trust them. You shouldn't. But they're all private sectors. So essentially they all have incentive to have favorable regulation for crypto. It's not so much that we should trust them as people or what they're saying, but they all benefit from it. And they do have knowledge. Not all of them are on the same page, but they, in general, for what we've seen kind of from the government so far, are at the higher end of knowledge when it comes to crypto. Some of them are very knowledgeable, in fact. Some real good conversations have come of this. But right now, it seems like they're all just prefacing kind of like what they are and how they're doing it, which is not really important to us as the viewer. Hopefully they get into some real stuff.
When it comes to settlement cycles. We also, I appreciate the shout out on 24/5/7 trading. That's, I think, a policy discussion that has kind of happened in, I'll call like the mainstay, but it really merges with discussion of tokenization and digital assets. And I think the commission would be well served thinking about 24/5/7 trading in the context of both asset classes. The other areas we think about are asset servicing and asset collateral optimization. So as I mentioned, we did showcase some of our potential growing abilities through the last month's collateral experiment, but also corporate actions, all the events where there are multiple intermediaries, manual processes. This technology offers great potential to basically lean out those requirements and basically move things forward. And finally, I think I would want to hit on eligibility. Currently, not all securities are eligible for central clearing. There may be good reasons why you don't want it to be, but I think the technology, the transparency it offers works very well. The wrapper that I think matters for all of this is interoperability. So folks have hit on this before, and I think one of the things I'd be interested in seeing this panel discuss and the commission consider further is how interoperability is going to work here, because while you may have multiple technologies, multiple tokenization platforms, to achieve some of, I think, the potential benefits that the technology offers, you need some degree of consensus standard setting and agreement. So if everything's on one chain or multiple chains, how is that all going to work? I look forward to discussing that topic and others today.
Okay. Why don't you just discuss it, though?
Thank you very much. I'm Sandy 𝐂𝐡. I'm here to speak on behalf of our digital asset unit at Franklin Templeton. Thank you to the chairman and to the commissioners for the wonderful support that they have given us over many years in our digital asset journey. And we're very excited to be here today at this moment in time when we are finally taking a common sense approach to thinking about the rules that can govern our future financial ecosystem. One of the things we would like to encourage everyone in this task force and thinking about regulation to consider is that we often get caught thinking about consumer protection and sometimes forget that we have an equal responsibility to ensure consumer opportunity. right? And I think that when you look at what has been happening in our computer age with the key technologies that are shaping this age, computing, cryptography, networks, and communication, these technologies have been evolving since the 1960s. We have to remember the foundation, the system that many people are looking to defend today was created because we lost the ability to keep up with trading one transaction at a time, right? This was the way that we operated in the markets for well over 100 years until the volumes started reaching a point where we could no longer keep up with them, and then we started to create this whole system of netting and book order entry and beneficial ownership accounts. And it worked very well for us, and we used the most modern emerging technology at the time to design it. Today, we have much better technologies that are the ultimate revision and growth of those four foundational technologies. And those technologies are putting us back into a position where we have an opportunity to think about having a system that can go back to trading one transaction at a time, because we now have the volume, we have technologies able to support the volume and the velocity and impose the controls that would be required to do this in a safe way. And so I think that this is an important point to keep in mind, right? The technology itself is enabling us to rethink what is the common sense approach, right? And the common sense approach says that every investor should be able to have as much control over their own assets as possible. Today's account-based system makes this extremely difficult for individual investors. It makes it extremely difficult for high net worth investors and mass affluent investors. Just think about how hard it is sometimes to fund a brokerage account, and how many days that can often take, right? So there's opportunities here to think about what the technology can do better. We believe at Franklin Templeton that today's system is overly complicated. It's riddled with toll takers that add costs to transactions that get passed on to the consumers, and that there is an opportunity to create a better system for those we are charged to protect. We at Franklin Templeton started our journey into blockchain in 2019. We tokenized our money market fund in 2022 and began to run our books and records from our transfer agent, our transaction books and records, on public blockchain. We now have deployed our system across 9 different blockchains, and we operate our wallet-based transfer agent system across all of those blockchains every single day. We've been doing so nonstop since 2022, and we have not had a single issue with the way that our system is operating. We are able to provide more accurate calculations to our clients. We are able to provide more efficient reporting. We have lower costs on our funds from being able to eliminate intermediaries. We have more opportunities to expand the classes of assets that we're able to bring into the asset class and diversification pool by being able to take investments that today are investable but difficult to trade and put them into a tokenization wrapper that will allow them to become part of everyday investor portfolios. The chairman and one of the commissioners mentioned even IP, right, and other types of rights that can become things that people use in their own portfolios, their own home equity. We are really at a unique moment in time where we can create the opportunity because the technology is now there to allow us to. We look forward to working with the Commission, and we look forward to working with our peers to really help move us towards that new world.
I'm Johnny Ryan, Executive Director of the Tokenized Asset Coalition. The Tokenized Asset Coalition is a member-funded nonprofit that consists of 60 or so members coming from all the leading protocols in the space, issuers from every asset, from stablecoins all the way to things more esoteric like IP rights. Just want to say thanks to the Commission for hosting us here, and it's very encouraging to hear the words that we heard earlier from the various commissioners with the balance that they espoused in those words. So excitement, and hearing Commissioner Peirce say words like composability and interoperability while the balance from the tone that Commissioner Crenshaw struck. I've been in the space since 2013, and if you told me that I'd be sitting on this panel today back then, I probably would have bought more. But just a moment of reflection for how far we've come, and it's a really, really exciting time. The reason why I was drawn to the space, and one thing I should say is views are my own, not the members. So if I go off piece, they can disclaim. But I started in 2013 when it was mostly just Bitcoin and a few others. And when Ethereum launched and the various technology around programmability started to be built, I started building in the space directly within tokenization. And I was drawn to it from the attributes of programmability, efficiency, transparency, and accessibility, fractionalization, allowing for lower minimums for people to get access to stuff. And a paradox kind of exists today in the market where the lowest risk assets, tokenized assets, stablecoins, and the most speculative assets are the only things that have access to DeFi in any meaningful way. And so there's an entire gap that I would love to see filled with thoughtful application, balanced application of regulation. I say that also with the recognition of having been in this space for over a decade and seeing us shoot ourselves in the foot multiple times and take too much risk on. And if you've been in crypto for as long as I have, a year in crypto is sort of like 10 years in a market, in a regular market. And I would like to see that balance come through in whatever we adopt. So one of my goals as the executive director of the Tokenized Asset Coalition is to provide some balance for our members that are, we all get very bullish. So the other thing that I would say is top of mind for me in my position at the TAC is global interoperability. Commissioner Peirce mentioned this in her remarks last week, but there's definitely this looming kind of silo or set of silos that could exist. And I think with various regulators adopting regulations across stablecoins and various other assets, I think the SEC is particularly in a great position to take a leadership role on how to regulate securities that are tokenized. And hopefully that can bring about some conversations with regulators globally about how to make this stuff interoperable. Looking forward to participating on this panel, and yeah, very excited to be here.
Hi, I'm Christine Moy from Apollo. Thank you for the
She
commission
seemed
for inviting
unsure
us and
who she
encouraging this
was.
discussion. We think the case for tokenization is rooted in its ability to fundamentally modernize how assets are created, distributed, and managed. We think tokenization brings automation and programmability to traditionally manual processes, streamlines operations and reduces costs across the investment lifecycle, and enables automated compliance. More significantly, it enables multi-asset interoperability, allowing different types of assets from private markets to public equities and fixed income to be represented, exchanged, and utilized together on a common infrastructure. So we think this unlocks new efficiencies and opportunities for both issuers and investors. At the same time, tokenization accelerates product innovation, giving institutions the flexibility to design and offer investment products that are more accessible and customizable, with the potential to broaden access to the diversification and investment benefits of private markets. So we see tokenization as just the next evolution of capital markets, merging the strength of the U.S. markets and our financial system with the programmability, composability, interoperability, and global reach of this digital technology. And I look forward to engaging with you all on this discussion.
88 looking good, finally. That's not a bad chart at all.
My name is Robbie Mitchnick. I'm the head of digital assets at BlackRock, and I want to thank the Commission for hosting this event today, and also to acknowledge the staff with whom we've appreciated the engagement and earnest work over the last many months, and in many cases, years on this topic. And also, I hope that you'll accept my apology for my contribution to ruining Christmas of 2023 and New Year's of 2024 in the frenetic run-up to the Bitcoin ETP launches that next week. Our purpose at BlackRock is to help more people invest better, including democratizing access to investing by enabling more people to have access to investment opportunities in an efficient way. And we have a strong belief that tokenization and digital assets have a potentially very important role to play in that. Given I'm last on this opening, I won't repeat some of the many thoughtful and incisive points that my fellow panelists have made here, but rather I'll focus just on one specific tangible example to illustrate the potential of this technology. And that is in the context of the tokenized stable value yield fund that we issued as a firm in March of 2024 in concert with 𝐂𝐡𝐚𝐫𝐭, who serves as our tokenization agent in that space. We think tokenization agent is a more suitable term here than transfer agent in this context. And what a stable value yield fund issued natively on a blockchain enables is the breaking of a long-standing trade-off that investors were forced to make between liquidity in terms of a cash asset that could be used in real time for settlement or payments, and access to full yield. In this case, we have seen the enablement of full U.S. Treasury yield through the tokenized yield fund, but through the properties of digital assets that make it possible to convert instantaneously into and out of stablecoins, which function as digital cash, that in effect the investor no longer makes that trade-off between yield and liquidity and has the real-time efficiency of both. Today, that's accessible just to institutional investors, but we are optimistic that in time that will become accessible to investors of all sizes and types, and also eventually that the benefits of tokenization, which many panelists have spoken to already, can be extended to additional asset classes as well. So we're very much looking forward to the discussion today.
Well, thanks for that, everybody. And
BlackRock man spoke. I think ADA looks good. I think 50 cents likely the bottom for ADA USD for this cycle. Definitely can see some 95-cent moves. A lot of these alts looking good. A lot of them kind of like ADA here, though, on the month, right up against a significant monthly level, battling it out, looking to see if they if the corn will allow them to break out.
Maybe I'll just start here. I think the way and Commissioner Crenshaw laid out that there might be a myriad of definitions, but the way I'm looking at the tokenization, and welcome for feedback, is it really is just an evolution of dematerialization. So it allows for registered ownership and programmability, but it really is you owning the security. And so that is what tokenization is. And then it's powered by blockchains, right? And so blockchains are really just a virtual machine. And then in addition, there's this overlay of smart contracts, which can create additional functionality, which is that programmability, which is the buzzword that many have spoken about. And so I really think, and Commissioner Peirce alluded to, the smartphone makes you smarter. A new file format for your securities enables new functionality like better collateral or actual utility in owning your assets and securities. So that's really what I think of when I say tokenization. It's just a new file format. And then maybe just to fill out the picture, we started with certificated securities. That was the file format that was used and appreciated for a period of time. Those, as was alluded to, were kind of became less in vogue when there was additional optionality and the crisis of the paperwork crisis of the 1970s. And what happened was a great migration from certificates to immobilized securities. We think, and has been likely will play out, is tokenization is the new file format, which again allows for more programmability rather than just sitting on a centralized database. You can attach additional functionality and uses like compliance features and/or payment of dividends or corporate actions and the like.
Yeah, just to build on that, I can offer a framework that's potentially helpful. And we published this about 1.5 years ago called the Spectrum of Asset Tokenization. And if you think about the basic attributes of an asset that lives in the real world, you want to be able to prove that you own the asset, enforce legal rights, track the ledger of transfers. We do that traditionally on paper. In my prior existence as a lawyer, I did that a lot on paper. But then with tokenization, you move from that paradigm, and the first step is just a representation of all that off-chain activity on-chain. So you have a token and you have everything else that lives off-chain, living side by side. And then the spectrum goes up to fully enforceable on-chain native issuance with all legal enforcement on-chain as well. And that would be like a decentralized finance protocol, like a lending protocol, for instance. And then you can have flavors in between as well. So I agree with everything Alex said, and I think each asset might have a different flavor of tokenization to take into consideration. For instance, an intangible right could be easily natively issued, have all legal rights kind of attached to the contract itself, whereas physical gold can never be natively digitally issued. Only the token can be, but the gold will always have to live in the real world. So maybe that's helpful.
Thanks. And Christian, as we're thinking broadly in terms of basic level setting, prefatory points, anything else worth adding from your end?
Yeah, so I think we've had a helpful start to the discussion.
Have we?
One other way
Have
I
we?
think, or another analytical framework that's helpful is, particularly when we are talking about so-called real-world assets, which for many years have just been electronically represented. So we're moving sort of from electronic to digital here. Various litmus tests that basically tell you, to the points that Johnny and Alex raised, that you, at the end of the day, do have a legally enforceable ownership, property right in the tokenized security. So, this is, I think, important in terms of thinking about if we tokenize an asset, what is the treatment of that asset? And for us at DTCC, this is always sort of like the question lurking in the background in a distressed market or a default scenario. In other words, if you do have a tokenized representation of an asset, is it going to walk and talk and swim and quack exactly like a security interest that you might have with an electronic or an immobilized asset today? Or if you were to basically have an actual paper certificate or an otherwise transferable physical representation of the asset. So I think that's important to keep in mind. The other thing, which I'll defer to my colleagues who are more, I think, focused on the trading side, but in terms of issues around if the asset's tokenized, how does that asset act and trade or otherwise get utilized relative to the prior or the ongoing parallel existing asset? These are issues I think the Commission has thought about in other contexts in terms of dual share listings. Folks have alluded to the potential NMS considerations, an economically equivalent tokenized asset trading alongside a so-called traditional one. What does that do for capital formation and so forth? These, I think, are the more in the weeds questions that can be useful in really teasing out, if you say you have a tokenized asset, is it really a tokenized asset, or is it a derivative of the asset in tokenized format?
And just really quickly on that note, it does get really complicated when you try and keep both sets of records, so the on-chain book and the off-chain book. And I built a company, my last company in the space, specifically within private credit, and it was always trying to get to a digitally native issuance of something so that it was less of a less chance for failure, basically, when one ledger doesn't match the other one.
Una, Christine, anything you want to add?
Sure. I think it all starts with taxonomy. We view it as sort of the foundational underpinning in terms of how digital assets and tokenization can be integrated into the existing system. And when you think about the investor choice, investor best interests, and investor protections as our North Star, and and start with that, having a clear and predictable taxonomy will help us to understand how best to adjust the rules and regulations to make sure that the new innovation fits into the space. And we've been able to do that in the past with different, not just with innovations in technology, but also innovations in products and processes as well. So, we've submitted a letter on taxonomy and other questions that were raised in Commissioner Peirce's February statement, and we have certain categorizations of it. But for today's discussion, I think it's important to think about financial security and whether distinctive sort of characteristics should be laid out from within the financial securities category. And to paraphrase Commissioner Peirce's statement is in that, digital representation of a security or issuing a stock on a digital ledger does not change the substance of that security. And I think that's a very important basic premise to start with, because then we can figure out what the rules of the road are with respect to how we then fit that into the existing rules and regulations, and also think about how to calibrate and adjust and update the rules based on that distinction. And then going down even further, I think there is a distinctive sort of characteristics with respect to private securities and public securities in particular. To point out the obvious, obviously there are disclosure requirement differences with respect to private and company issuers, but also there are different rights, privileges, and obligations of the shareholders as well. And over time, of course, there's been additional mechanisms and listing standards and other things that have been built, all to serve the investors in terms of providing reliable access, best price, best kind of environment for them to trade in. So, we should think about that in that context, and we should think about it in terms of, different mechanisms that have developed over time, whether it be trading and market real-time surveillance, whether it is notification with respect to corporate actions, not just because speed is lacking, but just so that there is orderly dissemination of material news to the public markets. There are things to think about in terms of trade halt mechanisms, both for volatility and for regulatory considerations.
Yeah, you
as
just
well.
shouldn't have those.
And then there's, of course, adjudication and reasons why certain trades are broken due to errors and other issues. So when you sort of think about that in the context of facilitating capital formation with clear rules of the road for issuers, investors, and market participants, then we can start out with a very clear, predictable taxonomy, and then expand our discussions from then on.
And just to build upon my fellow panelists' comments, I think the main thing for us to note in this discussion is that tokenized securities should not be confused with fair digital assets. I think we take that for granted, but worth noting, because tokenized securities we think of as permissioned compliant assets with embedded smart contracts to enforce transfer restrictions, legal constraints, and regulatory rules like AML, KYC, investor status, jurisdiction, et cetera. Despite being permissioned and compliant assets, we think about them in the context of operating on secure and sound, permissionless public blockchain infrastructure. A lot of lingo there, so certainly taxonomy is very important. But the main concept is, having compliant securities on public infrastructure with the right controls codified in. And then, building further on, kind of interoperability, I think the really interesting thing that we don't spend enough time thinking about is that, we really have an opportunity, to Sandy's point, to think about how we, kind of enable the best investments for the most people, as Robbie stated in his mission. The idea that tokenization, regardless of where it comes from, regardless of if you're a native tokenization or if you're, an asset in custody that's being tokenized or everything in between, is that you're actually ending up what you're actually doing is bringing all of these different assets together, as I mentioned, from private markets to public equities and fixed income, onto the same operating system, and enabling programmability and composability across those, which then enables us to build comprehensive, holistic portfolios that can be customized to a broader range of investors for their desires, right? So, it's important to understand.
We got 1,000 live viewers. That's a healthy stream. Guys, make sure you're hitting that like button. We barely have any likes on the stream. Join the Discord. Check out the links in the video description below. Go to join crowncrypto.com, etc.
Better investment products for the future.
Smash the like
Thanks.
button.
And just to pause for a second, taxonomy, other introductory points around the mechanics, etc. Just pausing to see if anybody has any other points they want to make or react to anything anybody said.
Just maybe raise a question on, because we use the term interoperable a lot. I think it has a number of meanings. When I use the word interoperable, I mean tokenized securities interoperable with their book entry version that's held, in the TradFi sense. But I think there's another layer of interoperability where we're talking about, there's a myriad of blockchains, Solana, Ethereum, et cetera, and interoperability between those. I think it probably means all of the above, but I think both of those are important to be mindful of when we're thinking of and discussing interoperable. But I don't know if there's other points there.
Just want to add back the regulatory interoperability is important too. Because even if you can technically move across chains, doesn't mean you can actually do anything with it on the other chain.
Sandy, we'll turn to you in a second. Regulatory operability, anyone want to chime in? Any other thoughts on that specific point? Christian?
Yeah, so there's different layers there, I think. One layer that I think everyone's very sensitized to, and I know this organization and related organizations are working on, is just across the diversified regulatory framework we have in the United States between securities products, non-securities products, capital market activity, prudential activity. The other layers, though, I think are a bit more nuanced. It goes back, I think, again, to this question of whatever taxonomy you come up with, you need to make sure that that taxonomy, I think, takes into account and respects other legal regimes that interact with our markets. So take collateral, for example. If we want to unlock the potential for tokenized assets to serve as a collateral optimizing force, we have to make sure that the underlying, and in this case, it's usually state commercial law regimes. The Uniform Commercial Code comes up, and we can have a discussion about Article 8 and Article 12 if folks want. But generally, you need to make sure that's compatible. I kind of take the point from what Johnny's saying. You can move it from one chain to the other, but if I can't perfect my security interest in the tokenized collateral on the other chain, it's not really going to do very much for me. So I think those are factors to keep in mind as you're coming up with the taxonomy to make sure they speak to that broader ecosystem. The existing framework has done that very well up to this point, so I'm not, I think, suggesting a new problem or even a problem per se. It's just a consideration that I think will take the potential very far forward.
Sandy?
Yeah, I mean, sometimes these conversations, even for me who understands everything everyone's saying up here, get a little complicated. I just wanted to go back to the absolute basics of it. A token is a wrapper, as someone said here. It's a new file format. But what is unique is that you can embed the contract that governs the regulation and governs the use and governs the transferability and governs the legal protections of that asset right in the asset. And the ledger that you record the transaction on can read and administer all of those terms that are in the contract that is embedded into the asset. And so if you think about today, there are hundreds of contracts that people need to have in place to be able to trade securities. And those contracts have to be reconciled back to the asset itself. And there are dozens and dozens and dozens of teams in every organization whose entire job is to reconcile back and forth between these contracts that govern the use and all those other aspects of the asset that I discussed and the asset. And the big innovation here, the big opportunity here is that we can now embed those contracts into those assets, and we can use the power of these calculation utilities to make sure that these assets can be properly administered without as many manual interventions and without as many problems that can potentially come from all of the problems that come with people trying to do things and move between documents and other systems. And so it really is a huge enhancement beyond just being a new wrapper, right? It really is a way to make the system work more automatically and more effectively.
Robbie, let's
Wow,
go
pie.
to you, and let's transition now, thinking about the concrete opportunities, what's working well, where are there gaps, both in terms of thinking about the infrastructure and the legal and regulatory regime. Talk to us in terms of what you're seeing at BlackRock in terms of the existing infrastructure out there and opportunities, challenges, et cetera.
Sure, Jeff. Well, certainly there are many parts of our existing market infrastructure that work quite well today, right? And I think that in some respects, some of the slow-ish progress that has been made in terms of tokenization adoption to date, while some of it may be related to regulatory clarity that is now trying to be addressed, some of it is a function of the fact that if the existing market infrastructure works pretty well, there's a high hurdle to migrating to a new
You're a high
standard,
hurdle.
even if there's a recognition that that new technology standard is an improvement over the existing paradigm. But there are certainly areas where we believe there have been significant step change improvements enabled by tokenization that give strong conviction in the merits of making that migration. And one such example where we're seeing early benefits realized, but there's potential to do so at a much greater scale, is in the context of collateral, where tokenization makes it possible to pledge, to rehypothecate, to have transparency into, to liquidate in near real time various forms of collateral instruments. And if you take one example today where the existing infrastructure and regulatory regime is not really in a position to support this, it's in the usage, for example, of money market funds as collateral, where the existing paradigm makes that difficult to do at scale. But when you think about tokenization, we have the opportunity to migrate from a world where to actually post a money market fund as collateral, you first have to liquidate it, deliver cash, and then instruct reinvestment into a money market fund, which is obviously a very inefficient and friction-filled system, which can also add sell pressure in times of market stress into the underlying funds and their underlying collateral. And now, with this new technology paradigm, there's an opportunity to do this through a direct, nearly real-time pledge that's transparent and enables instant liquidity on a secondary basis into, for example, stable coins as digital cash instruments. And that has wide-reaching potential implications across many areas where collateral is a critical part of our financial infrastructure, including derivatives, repo, and securities lending.
Sandy, over to you.
If I could add to what Robbie said, because I 100% agree with the points that he made, take it even one step further, right? If we tokenize the underlying securities that sit in the government money market fund, and we come up against another 2008 type event where there is uncertainty about who is going to be able to access that underlying collateral. I mean, don't forget, this tied up some of the lawsuits around Lehman Brothers for 2 or 3 years to be able to figure out who owned the underlying collateral. If we could immediately move from the tokenized money market fund and into the tokenized assets that sit within that fund, we can immediately get the collateral and begin to unwind all of the obligations in the marketplace, right? So this is another improvement where, you know, having these off-chain assets and these contracts that govern it constantly make us go back in periods of stress and try and figure out how can we accelerate the return of collateral, how can we accelerate the unwinding of positions. And tokenization can give us far superior answers to those problems, and ones that move at the speed of the market so that there would be less stress in the market, because you can have immediate dissolution of a fund and immediate distribution of its underlying assets, right? So these are points that often get overlooked in why today's systems don't work very well. And this is someplace I think that we would see massive enhancements if we were to move in this direction on a broader basis.
Johnny?
Yeah, I just want to add, there's a really great example of what Sandy just mentioned at work during one of the biggest crypto market shocks of the entire time I've been in crypto. Terra Luna was a synthetic stablecoin that crashed, and I'll make no judgment about how it was built, but in decentralized finance, which housed a bunch of loan transactions by smart contract, collateral was sold and liquidated, and lenders were repaid pursuant to the terms of the smart contract, even though there was a massive amount of volume that hit the system at that time. Everybody got repaid, and everything worked the way that it was supposed to. So we've seen time and time again that what Sandy is describing works really well and in real time.
Yep, so I think we all kind of share the goal of fungibility, interoperability as a achievement that we want to have with respect to tokenization. And I think what's also important to remember is that that probably is going to require methodical peeling of the onion in terms of how we get there, because we all want to try to get to that place. So, you know, when you think about sort of what we have now, there are aspects of the system that are resilient and robust and really provides a great opportunity for investors to make decisions, even when there is unexpected news like we had on April 7th, in terms of being able to make financial decisions in a very quick way. So I think the big, you know, question mark is how can we preserve the benefits of those mechanics and market characteristics, and then apply it and integrate this new technology into the system in a seamless way for wider adoption. And when you think about it from a sort of a legal framework, of course, we have the state laws, both in terms of the corporate statutes and commercial statutes. And I think while some of the you know, jurisdictions like Delaware and Texas have adopted blockchain technology as part of their and allows corporations to adopt that technology for stock ledgers and corporate records, there's still probably room in terms of additional work to be done in terms of making sure that that is available to the corporations. And then when you're looking at the securities laws, you know, separate and apart from just offering registrations under the 33 Act, there's a bit of work to be done with respect to the 34 Act in terms of the registration of a security under the Exchange Act and what that means and what the thresholds and triggers and the privileges and the obligations of being a 34 Act security really means, not just for the issuers, but also for the investors as well. And then, you know, there are sort of ancillary, but just as important things to think through in terms of how that also interplays with regulatory regime under NESMIA and cover securities and the blue sky laws. And that's just the tip of the iceberg. And so I think we have a little bit of work to do with the staff at the SEC, and I think we're all ready to roll up our sleeves and think through those matters. But I do want to end with an opportunity to just build on what Robbie said about collateral management. I think there's a real opportunity here to ease congestion with respect to proxy plumbing and processes. You know, when you think about tokenization or DLT technology in particular, there may be ways to track security ownership in a way to get rid of the 20 business day broker search rule, which already seems a bit obsolete given the T+1 settlement cycle, as well as the special dispensation that is being given to special meetings. There may also be a way to address the gap between issuers and objecting beneficial owners without giving up on the privacy rights of the holders, and also addressing broker-dealer considerations as well. And then, of course, there are, real opportunities for dissemination of information, proxy materials to the investors in a quicker way, cheaper way, as well as thinking about how blockchain technology can be used to tabulate votes, audit them, and have real-time information. So I think those are really interesting and exciting ways to think about tokenization and DLT in particular.
Alex?
I just want to touch upon, collateral and proxies are fantastic use cases. I also would be remiss not to highlight that the technology also can enable, fantastic lending of your actual securities, and then additionally, exchange that can happen in a much more economic way. So, lending right now, you're subject to your broker, and that's the only person you can really utilize for a borrowing venue. But within crypto that exists right now, the founder of Superstates, Robert Leshner, he created Compound, which is one of the first DeFi lending protocols and has done billions and billions of dollars of lending, but has only utilized crypto assets. To the extent that more real-world assets and securities move on-chain, those types of primitives can and should exist. Similarly, market makers have been printing money by creating price improvement, and maybe we can touch upon Reg NMS later on. But at the end of the day, a system of trade doesn't, and maybe we take a step back. 1975 amendments, they didn't envision one central limit order book as a national market system, right? They envisioned a subsystem and various other integrated systems that work together as being a national market system. If they had envisioned one central limit order book, we wouldn't have a myriad of exchanges, and we wouldn't have the advancements of the early 2000s into the ATS world, and we wouldn't have where we're sitting right now, where there's the ability for decentralized exchanges to allow for peer-to-peer interaction and the ability for you actually to directly earn some return from providing liquidity. And so I think obviously low-hanging fruit is collateral. Low-hanging fruit is peer-to-peer in a direct manner. But additionally, enhanced through a protocol, there's an ability to do a lot more in different things. And so I think that is, we would be remiss if we don't touch upon that in the benefits of tokenization.
Cynthia?
So you actually said something that really strikes me as an important point. We talk a lot about the technology, but you just talked about financial primitives. And so, a point that we talk a lot about is finance is still finance. At the end of all of the conversations around the technicalities of the things that this technology can do, and what this technology and moving assets on-chain to be able to be loaned or used as collateral in a pool that it enables a wider range of access to capital. So this is really, at the end of the day, about facilitating more efficient capital flows by creating these new structures that will, create more direct access for individuals to use their assets in ways that today are limited by the intermediaries, with which they are, currently engaged. And that, we think of as tremendously an improvement for access to investments and capital.
No, Sandy?
I just wanted to also bring out one other, I think, very important use case that we are seeing in real time, which is the way that we calculate what we owe shareholders today is really based on the next morning's shareholder record, right? Because we need this time to reconcile the shareholder record, we need this time to record the shareholders. And so when we award interest on a fund or dividends or corporate actions on a fund, we're awarding that the next day. And in the case of money market funds, we accumulate those awards over the period of a month and we pay them out monthly, right? This is a very inefficient way of doing this because we have built our blockchain transfer agent on blockchain and we are settling every single transaction as it occurs. We are able to calculate our shareholder record in real time, and we're able to break our shareholder record out by increments of the day. We've chosen to use 1 second increments. So, you know, for corporate treasurers who come in and they put money into a money market fund in the morning, but they've needed to pull that because there were unexpected expenses that they needed to cover later in the day, right? They are unable to get any of the interest for that period of the day that they held the money market fund because at the close they were not a shareholder of record. With the new way that we're doing this via smart contracts and tokenization, we're able to create an exact record. So if that corporate treasurer held that money market fund for 4 hours, 32 minutes, and 17 seconds of the trading day, they would get 4 hours, 32 minutes, and 17 seconds of the interest, and we pay it out every single day in incremental new issuance of the token, including Saturdays, Sundays, and holidays, right? This is a huge improvement in the way that the market works, and this would be available to all investors who held tokenized funds. It is something that is not available today, especially when you think about long weekends, right? If you purchase a money market fund on a Thursday, that doesn't really get settled until the following Monday if it's a 3-day weekend, or the following Tuesday if you pick it on a Friday and Monday's a holiday. These are all inefficiencies that we just all live with in today's system that we do not need to live with going forward.
Well, we keep touching on it, and let's now drill down a little bit in terms of regulation. We're through a couple different threads here. Christine, I'll start with you, then maybe go to Christian. As you're looking at the landscape for regulation, what's good, what's working well, and what are impediments out there for the commission to think about?
Sure. We think one of the most compelling regulatory opportunities in this context of tokenization is the modernization of the transfer agent rules. As we mentioned earlier with tokenized securities, like the core compliance functions like KYC and AML and jurisdictional limits, investor accreditation, can be embedded directly into the smart contracts and automated. So what that means is that, you know, essentially smart contracts are doing the transferring. But we think that there still requires a regulatory layer. I think you said it well when you said digital transfer agent or tokenization agent. You know, is basically a function for this new infrastructure that can help manage edge cases like wallet recovery or freezes, sanctions compliance, and complex corporate actions. So we think that there's a real opportunity to, you know, enhance that definition. We also think that permissionless public blockchain should be recognized as official record of ownership. I think there was mention about duplicative record keeping that's required. And so being able to clarify that specifically would eliminate the duplicative off-chain record keeping, streamline operations, and unlock the efficiencies that tokenization and digital assets has promised. Another key area that we think about often in tokenized securities is the 3-step process. We think that, as I mentioned earlier at the beginning, tokenized securities are neither crypto commodities nor bearer assets, and have the smart contracts with the embedded transfer restrictions, so should meet the 15C3 possession and control requirements. And so we think assets should be eligible to be custodied and traded by broker-dealers without triggering the 3-step process. Additionally, self-custody, I think this was, you know, kind of mentioned in opening comments. Self-custody should be an investor choice, should be permitted when chosen by the investor. It enables direct access to innovation, reduces intermediary fees, and supports user control without compromising regulatory oversight. And then, when it comes to settlement, we think blockchains offer, great automation and transparency. And so we think tokenized securities can and should be settled using stablecoins, just as cash is used in traditional finance, without imposing extra regulatory burdens, simply because the payment rails are digital. So those are just like some of the areas that at least us tokenization nerds spend a lot of time thinking about.
Christian, anything?
Yes, that was a pretty thorough list, but I think what I think I would add to it, and I think this kind of, I'm going to go back. I know it feels like we've kind of beaten it a little bit too much, but the interoperability point. So a lot of the potential efficiencies that have been highlighted by folks on the panel are all great and well, I think, in sort of unique sort of environments where you have a universe of actors or parties who can perfectly kind of control what the environment is, particularly in terms of, like, as Alex alluded to, like, there's different sorts of chains technologies out there. There's different sorts of programming languages. So if folks are making those choices on sort of a disparate basis, you have to worry about, like, the issue of fragmentation, and something that I think current regulatory approach over the years has done a really good job of is dealing with, like, market liquidity. So we don't want to kind of go back or create, like, a new set of problems where if we allow, 1,000 tokenized ecosystems to bloom, they can't interact and interoperate with each other really well. Now, I'm only familiar with one context where the Commission attempted to try to address interoperability, and it was in the very narrow area of central matching. But I think it's fair to say that's not really an area where a regulator sort of prescribing how interoperability is going to work did very well, because I speak as someone at DTCC. There's only one central matching service today. But I think if you look to basically really unlock the potential of this and scale it to the level of a national market system or a national clearance and settlement system, outside of just reducing inefficiencies within specific asset classes or regulatory ecosystems, you really need to think about how do we ensure that the market is dynamic enough that if I have my assets on one chain and Una has her assets on the other chain and we want to interact with each other, it doesn't matter that the chains are different, that they have different protocols, that that basically for us it's just as seamless as all the benefits everyone's been describing. So that's one thing. The other thing I would bring up, and this is kind of a mixed bag, because on the one hand, a lot of regulation, particularly I would say in the Exchange Act world for market intermediaries like ourselves, is that on paper we have a lot of flexibility to adopt reasonably designed policies and procedures to take care of topic X, Y, Z. Well, in the technology space, that's not always as flexible as you would think, particularly with new and emergent technologies. So, and I'm not even thinking of ledgers. There's other technologies that have come up over time, AI, cloud, all sorts of things, right? And there's obviously a very legitimate concern, which I think will persist in the future, about resiliency, about availability, about safety. I say this as someone who took the train from northern New Jersey today as opposed to other options. And so effectively, I think what we need to think about, I've seen it in the public comment file, you take regulation SCI, seems like very strong medicine for trying to sort of get something off the ground. But some sort of directional guidance or clarity around how market participants are going to start using these new technologies in a way that on the one hand supports market resilience, liquidity, and the great public good we have of the U.S. financial markets, versus something that is not too overly prescriptive, I think is something that's needed, because it's just been very, very challenging, I would say, to really at scale try to implement these new technologies to really get you to some of the places that folks on this panel have been very persuasively describing.
Christian, I have a question on the follow-on and for the panel. I agree and think about the interoperability challenges the same way. Can we get best price in the market at high speed, high capacity, in the way that we would with traditional securities today to benefit our end investors? Who should determine or unlock the interoperability challenges? Is that something that we think we should ask of the Commission, or is that something that we as an industry should coalesce around, a la the fixed network and and what we've seen there.
Yeah, so I lean more towards, it should be people on this panel and people in this room. I think what I am suggesting is, though, that probably what would be useful is for the commission to consider laying out some high-level guideposts or considerations, like what are the things that interoperability should accomplish? What are things that, you know, are considered to be at odds with interoperability, so that at least we have, it's kind of like another taxonomy point. We have a common set of principles that we can use to dialogue with each other about what interoperability looks like.
I also think there's a disclosure point in there too, Christian. So as an issuer of a tokenized asset, if you're trying to design risk factors, you should probably take into account the network that you're issuing on and make sure that the risks of that network are clear to the people that are purchasing your security.
But there are available answers to these issues that are being brought up. I mean, we operate across 9 different blockchains, 4 different programming languages across those 9 different blockchains. We, as the transfer agent, have built a wallet-based system that is able to internalize any transfers across blockchains. We have an allocation system that really evaluates the characteristics of each blockchain to see if it meets certain standards. And we have gone back to some of these blockchains and looking to explore and deploy on them and made them enhance certain of their security characteristics to be able to feel that they are a sufficient location where we have trust in the technology that it will operate as expected. So, you know, we're solving these issues in real time at our firm, and I think a lot of our learnings could be very quickly adapted across the industry. The one other point I'd add, I think, is that it got a little glossed over, but I think it's critical. There are some new models. There are some automated market-making models. We hear so much about all the applications of agentive AI, and how people are deploying AI into their investment processes, and everyone seems to think this is a great idea. And yet we have these new pooled investment opportunities where any participant can join in a liquidity pool, and we seem to be ignoring the opportunity there to get over some of the fragmentation that we have in the marketplace today by letting people join liquidity pools and benefit by adding liquidity into the pools. And so I think that we also need to go back to my very early, you know, this should come back in the end to not just how do we protect the consumer, but how do we create opportunities for the consumer. And this is one where there is a tremendous opportunity to let them into models that have only been preserved for the most niche of financial players in the past. And I think one of our responsibilities as an industry is to think about how to really create that more equal playing field.
Just to answer Will's question, I think it's also important to think about corporate issuers' perspectives here as well. You know, we should think about how many of them who do not really interact on a daily basis with the financial ecosystem, other than for the fact that they have registered public securities and that they trade, they're going to want to have clear, you know, rules of the road, not just for themselves, but for the intermediaries and for the market participants and for those who are supporting the market. So just going back to everybody's sort of comments about vertical sort of silos and a potential for regulatory arbitrage with different sets of rules, I think we need to just make sure that there are clear sets of rules, treat like assets alike, treat similarly situated market participants in the same way, and that's going to give comfort to the corporate issuers who are going to be part of this new technology, who are going to have to be the consumers of the new technology as well. And I think that's going to help us sort of think about wider exception if we're able to have standardized sort of practices and rules and regulations.
Question for Will. Thinking about calibrating regulatory requirements. If we think about a tokenized NMS stock, should regulatory obligations and requirements change? Should they be modified? Talk about that.
Well, our view would be that the regulatory requirements for an NMS stock should not change just because the product chassis has been changed or the security chassis has been changed. We do think we have a strong regulatory framework to build off of. It's not perfect, but I think the foundation's there. And through regulatory innovation, I think we can adjust for some of the things that we've talked about. One of them was the interoperability discussion that Christian just teed up, and so we won't go back into that. We have talked about coexistence, where we have a TradFi listing of a security sitting side by side, a digital security, and having that under a common regulatory framework, I think is fundamental to having a continuous market where natural arbitrage mechanisms can come into play and make sure that end investors are getting the best price in the market. I do think there's also this sort of issue of who can tokenize a security, or from an issuer perspective, who can tokenize a fund, an ETF, or a security that's been listed. And we have seen instances that more, I'll say on a global basis, that it's been a challenge, as to what that means. So bringing it into an NMS framework, into a regulatory framework, I think will put to bed some of the risk issues that we see in there, where credit could become a problem, where a platform and protocol, is an underlying credit exposure to the participants on that, and then the accessibility issues that we talked about before, and understand the price consequence of being able to interface with those at high speed. So those are some of the big things that we think about.
Una, anything to add on that one?
No, I agree with what Will has said, and I've sort of touched on that in terms of sort of the current practices that we already have that gives predictability to the investors and corporate issuers and other market participants as well. So I think it's really important for us to just think about all of those benefits and just put it into the context of the existing system, and just putting it into the context of some of the numbers, especially given that we've seen some record volume in the month of April, and I know we had a busy day earlier today as well. So, NASDAQ alone during the week of April 7th traded $1.2 trillion. And just on the 7th alone, there were probably, more than 900 million messages within a given minute. So when you think about sort of the volume and the traffic that is involved in the current system, we just want to make sure that we're very thoughtful in terms of how to provide those benefits to all the participants as we move forward.
Let's talk for a moment. Oh, Alex?
Could I just hop in? So I think I agree with what Will was saying with regard to Reg NMS, but I think when you're looking at these securities, one that exists on-chain and one that exists in the traditional database, I think there's a clear regulatory out with regards to the on-chain securities, because they would not be, and when we talk about NMS, most likely we're talking about 611 and trade through protections, and how would that exist on-chain? I think the way that exists on-chain is these aren't trading in a regular way, and so these can trade in a different way, and therefore that restriction should not apply. Similarly, when we're looking at best execution, like when does that attach itself, right? That attaches itself when a broker is involved in a transaction, and so if this is something that an individual is doing, there's a different standard that's being held and should be accounted for there. Furthermore, best execution is not best price, right? And so there's a whole myriad of things that can go involved in that, and furthermore, like this different structure can coexist and interoperate, but when we're looking at things, and I think this, if you go back, there really is an issuer and there's an investor with capital, and how they operate and interact with each other from there is all a construct, right? And so we can really be, as we shape what is necessary and required, what we should do is we should look at the risks that are attendant, not just what has been done previously. And so if there isn't a risk of fraud or misappropriation or various other things that are involved there, those shouldn't attach, right? Similarly, if there is technical risk or harms that could be present, there should be, as was alluded to, generalized standards that are held and maintained to ensure that just because something is on-chain, there isn't a regulatory arbitrage. There's just a different approach because it's in a different setting, similar to how NMS applies to what we have considered, traditional finance. On-chain finance unlocks completely new opportunities and restrictions and regulations that should apply, such as, code audits and resiliency tests and various things like that. But the other thing is you don't necessarily need an intermediary, right? Like on-chain activity that is governed through autonomous code does not have an intermediary. And so when I go back to there's an issuer and there's an investor with capital, the issuer is involved in running a business. They typically, and has been alluded to often, enlist a third party, like a transfer agent, to handle the record of ownership. And maybe a better term for this transfer agent or this improved intermediary is this tokenization agent, where they can control and ensure that the standards that we collectively agree to that should be held on-chain are maintained. So I think that's how you get to this interoperability and you unlock new use cases without introducing additional risks.
Will, I want to make sure I get to you on the following question. Commissioner Peirce, in her request for comment, she raised 40 Act issues, and in particular, whether tokenization of redeemable registered investment company securities, whether there's any unique issues to discuss there. What do you think?
Yeah, well, since 1940, the Investment Company Act has really endured in large part because of the Commission's ability to use their tools in rulemaking, exemptive relief and no action relief to adjust for innovations in the market, albeit technical or market driven. And here, again, we think they could use those same tools to help affect changes that we'd call out across a couple of different points. One of those is a topic that we've already hit about the single book of record. I think that is something at a transfer agency level that could bring efficiency to all of our operations, and we've hit on that pretty hard. The second is around the investment company's access first disclosure requirements for investor communication documents like prospectuses and shareholder reports. Again, I think there are efficiency gains from using this technology to tackle that, but it would require some form of relief. And lastly, I think it's kind of bridging into a more complicated topic of the dual share class, where the Commission is currently working through, I think more than 50 different filings there. And that topic does lend itself to this issue of would we see a mutual fund, ultimately become tokenizable as well? In there, we would have the 2a7 money market funds. We think these funds can perform a very valuable function in the ecology of our workflows. And if they do evolve into the ability to trade 24/7, which we've also talked about, then there is an implication of the forward pricing rule under the Investment Company Act of 22C-1 that I think would have to be under consideration. Those are a couple of different topics that we would bring up.
Others on the 40 Act?
Yeah, that's where having automated market makers that are able to create real-time pricing could come into play as a very effective way of evolving the system. I think that the other thing to realize with the 40 Act fund is that, the mutual fund structure itself has many inherent tax inefficiencies, that we are already seeing a pretty significant migration of money out of the 40 Act mutual fund structure into actively managed ETFs, because the ETFs have better ability to give that flexibility to manage the tax basis on the fund. And it has the create redeem ability that gives more flexibility on how to actually trade the portfolios. I think that if you look at where we could go with tokenization, it would really be an evolution on the ETF structure itself, because in a sense, the ETF structure is like a token that is wrapping all of these different securities inside of it. and we can unwrap, burn, or we can mint, create those tokens. In the ETF share classes today, it's a very apt analogy to think about how a tokenized mutual fund or a tokenized ETF might work, where the token becomes that instrument that's programmable that gives us better functionality for administering and maybe taking away some of the tax disadvantages of the mutual fund 40 Act structure. So I think that, it's 2025, something that has served us well for 85 years, definitely, and has evolved, to Will's point, definitely deserves to be able to continue to evolve. And that might mean changing the way we think about how some aspects of these 40 Act mutual funds operate.
Cynthia?
So absolutely agree with everything that Sandy just said about the innovations and the opportunities for traditional mutual funds. Having been in this industry at the time when the ETF structures were first considered, and this idea of having shares of an open-end mutual fund traded in the secondary market was a very big deal. And there was a lot of conversation about how that could actually be enabled. And now we see where the ETF industry is, and as Will highlighted, there are conversations now to expand the availability of dual share class open-ended funds. And so then you think about tokenization and where ETFs had the ability to be able to transact in kind in order to create better portfolio management efficiency. If you can trade the token, which is the wrapper of all of those assets in the secondary market, and have that be more efficiently transacted, then you are absolutely creating a much more efficient portfolio management construct where you don't have to go and mint and burn or redeem and subscribe each time you want to make a transfer of those assets.
And if you're in the commission's shoes, you're thinking about both broad principles and then the specifics, both very important. We'll get into the specifics in a moment around intermediaries and otherwise, but Robbie, why don't you talk us through in terms of broad principles in this space in terms of a pathway forward for the commission?
Yeah, well, I think a lot of it has been covered in various ways, but the way that we would maybe summarize it from a BlackRock perspective is that as a baseline, the same security should have the same regulatory treatment regardless of the form in which it takes, whether that's traditional or now tokenized, with some exceptions, because that starting point is imperfect when we're talking about a new technology paradigm. And it raises two sort of sub-questions within it. The first being, what are some ways, tangible ways, that is actually not happening today? And two is, what are some places where there is an inapplicability of the existing paradigm to a security that now lives in a tokenized format? So to give some examples, in the first category, as both Christine and Sandy talked about, being able to recognize that a blockchain is a perfectly valid, definitive record of ownership and transaction settlement. Discussions around broker-dealer ability to touch tokenized securities, to touch and settle in stablecoins, putting aside some of the challenges that Chair Atkins noted in the open around the special purpose broker-dealer framework for crypto broadly. We would say that tokenized securities got caught up unduly in that, and that pretty clearly broker-dealers would benefit from the ability to trade, to custody tokenized securities, as well as to transact in stablecoins. And then the second category, some things that are novel opportunities that if you just stuck rigidly to that principle of same security, same regulatory approach, we would lose some of the potential benefits that this technology provides. The discussion that I gave earlier and others added to around collateral, where tokenization makes the opportunity for collateral much broader and much more efficient, but that requires rethinking some of the existing regulatory paradigms that we have put in place under the existing traditional infrastructure. Another being in the area of KYC and AML, where not only would it limit some of the frictionless interoperability and liquidity that this technology offers by being able to, or by being forced to, issuer by issuer, fund product by fund product, go through an onboarding and KYC process, but actually it misses an opportunity to create a much more robust and transparent AML KYC system, potentially in enabling some form of decentralized utility powered by smart contracts to actually manage a transparent process and ability to port credentials, KYC credentials, across issuers and across fund types. Now, the industry has not yet built such a structure, but there likely will come a time where that happens, and it'll be incumbent on us to have a constructive dialogue such that we can help shape a regulatory approach to actually unlocking the power of that breakthrough.
Sticking with regulation for a moment, intermediary categories. We've touched on transfer agents, broker-dealers. Alex, and then maybe Christian, as you look at the existing framework, what should change, what's working well? Over to you.
Yeah, I think with immobilized securities, the structure that we have works very well, right? I mean, as you were alluding to, there's trillions of dollars that is transacted on a daily basis. I think when you move on chain, I think there's opportunity. Like I was alluding to, there's really an issuer and there's investors, and then everything else can kind of work its way back from there. Broker-dealers can exist on-chain, right? And they can have a wallet infrastructure that can work and facilitate that. National securities exchanges can exist on-chain, but don't necessarily need to exist on-chain, right? DeFi protocols that facilitate automated market making, there's not really an intermediary there, and that's possible and should be permitted. And so I think there, what we have to do is take a step back, look at the various, like I was saying, the various risks that are involved, and ensure that those are being adequately met. But I think one of the things that has been alluded to is arbitrage in a negative way, but we also just brought up the ETF, which is one of the greatest innovations and is driven by arbitrage. And so, like, having the ability to have, to beat the dead horse, interoperability, or the ability for securities on-chain and securities off-chain to move and go back and forth with each other, very much mitigates a lot of the concerns and the risks with regards to price dislocation. Right now, that exists in our market structure, there's securities that are listed in Canada and securities that are listed in the United States, and there's numerous empirical studies that show that they trade within parity because there is this ability to arbitrage and keep prices within parity. So I think all we need to do is ensure that risks are properly viewed and addressed, and we think you can do that through a transfer agent or a third party that is similar to national rating agencies. They have a technical capability of determining the creditworthiness of an instrument. Maybe there similarly could be a type of intermediary that can review and judge various DeFi protocols to ensure that they meet certain standards and thresholds for resiliency and technical capabilities. So I think really just right-sizing the risks for on-chain activity and ensuring the ability for the national market system to exist in these subsystems through the ability to move securities on-chain and off-chain, and then filling in the gaps from there with regards to what technical registration is needed is how the approach or the commission should take, rather than saying we have a clearing agency, a broker-dealer, and an issuer in this context, and we need them in this other context. I don't think that's how that rigid approach should be taken.
Yeah, so I think intermediaries will and frankly are evolving in response to this technology. I also think, and Una raised this in terms of the issuer voice or the investor voice, intermediaries are obviously a hot topic of debate when we talk about tokenization or digital assets, but if you go back to first principles, I think they have pros and they have cons, and some of the pros are if you're an individual investor and you have the rest of your life happening, you want an intermediary who's going to do that vetting of different chains to make sure that they meet certain standards for security, for resiliency. You want parties to be able to you want to outsource that ability to other parties so that you can do the things you want to do. So I think in terms of the future trend, it really is about choice. There may be some market participants who want a more intermediated interaction with tokenized assets than others. Certainly, they'll take into account costs and what people may characterize as rent-seeking or basically frictions, but they may see trade-offs in terms of the ability of scaling through an intermediary, the ability to deal with concerns about protection, security, and access. And I think that just needs to sort of play itself out organically over time. And the point's well taken. You can have registered entities that are showing up on chains. You can have through smart contract technology the functions of registered entities acting. The last point I would note is, if you are started moving away from the status quo intermediated market structure, and look, I think one of the great promises of this technology is it gives us a new ability, as others have described on this panel, to deal with long-standing frictions that come through the current intermediated market structure. So there's definitely benefits for all here. But one thing we are talking about trading up here a little bit is financial risk for just very, very, I think, fundamental technology risk, relying on chains and smart contracts, automated market makers to be there to perform when you need them for capital formation, for pulling money out of your 529 so you can pay for your kids' college that's coming up. So I think something that needs to continue to remain in focus is what are the technology resiliency standards and who's going to enforce those? Is the commission going to directly enforce those? Or are they going to, again, look to software providers? I know we've tried to get away from that, right? That can be problematic with unintended consequences. But the bottom line is I think intermediaries stay in the mix, but maybe the choice of intermediation is expanded, and that's probably a good thing.
I want to make sure we get to regulatory innovation programs. We have about 15 minutes left, just under that. Cynthia, Commissioner Peirce on May 8th made a statement about a potential SEC exemptive order that would allow firms to use DLT to issue, trade, and settle eligible tokenized securities. Sounds very interesting. As you think about this topic broadly, pilots, regulatory sandboxes, what comes to mind for you?
Very much supportive of having more formal programs of the sort, as a lot of firms are investing heavily into developing applications on chain for financial activities. And so there's a few terms that I think have been used across different global jurisdictions for these kinds of programs, whether it's a sandbox, a safe harbor, or a pilot. And they take different forms of whether it is a group of market participants across the entire transaction chain to participate and using real market value in order to demonstrate how it is that this technology can actually facilitate a particular activity, whether it is trading and settlements on a blockchain, or whether it is issuing new products on the blockchain. And so I think all of that is incredibly helpful and productive for participants to be able to actually operate these applications. Some of the challenges, though, is where you start to set, what are the objectives for having this proliferation of projects, and what are the objectives that you're hoping to be able to demonstrate, whether it is for a new, market and trading ecosystem. We've talked across the panel today about a number of practical issues. So how do you actually get to a scalable pilot to be able to address, many of these considerations? And then the other, consideration is global regulatory participation, given how global our capital markets are. Having global policymaker coordination and collaboration as you think about these on-chain assets moving across jurisdictions. Technology is cross-border. How do we, and I think we talked a lot about the word interoperability, how do different regulatory regimes recognize these assets as they become available to individuals within their jurisdictions? And so, the idea of a sandbox is incredibly, productive and helpful as we want to facilitate innovation. But I do think that there are a number of considerations that will go into creating a program that will be durable.
Will?
Well, I'm going to echo many of those points and first start off by commending Commissioner Peirce for her remarks and the guidance there to develop the regulatory sandbox for us. We believe the SEC should formally move forward with that concept and definitely support it. As just discussed, I think one of the big issues is about bringing innovation onshore. So how do we maintain the sort of most trusted regulatory framework in the world and the competitive capability to continue to attract capital? I think comes from the spirit of innovation. And this is something that I think we have the ability to adapt the framework to drive that onshore and to do these safe harbor and pilot programs that allow it to bring it into the appropriate regulatory framework that has served our investors so well. So, whether that is, completely calibrated or time-bound, I think there's the question of how do we implement this? Do we crawl, walk, run into innovation? How do we pull people into it so that we can coalesce around the protocol choices and understand that? And I think key participants like exchanges, the members-based framework, and DTCC can be leaders in this space that enable us to work toward a common solution.
So we have about 8 minutes left. There's two other questions we can get to that we don't have to get to them, but I wanted to just pause and see any of the panelists, as you're synthesizing the different comments that have been made, anyone want to jump in with anything that's lingering?
I'd just like to add one thoughtful request in designing, because I agree with Cynthia and Will's points about, really the benefit of having a robust sandbox environment and what it could create for us. I would just encourage us, though, to make it a practical sandbox, right? A lot of the early sandboxes focused on what could the technology do. I think there's pretty widespread understanding now throughout the world on what the technology is capable of doing. Right, and so I would encourage any sandbox we design at this late stage in the game to be very focused on how can the pilot run in the sandbox or how can the test run in the sandbox directly inform the creation of legislation or the creation of new regulatory rules that would allow us to improve and move the system forward. Right, I think the time for experimental sandboxes is past, and it's time for sandboxes that are going to prove out how new rules might operate. That would be my only real request for in thinking about and designing this program.
Johnny?
Yeah, and just on that note, being somewhat crypto native, this might seem counterintuitive to folks in the audience, but what would be really interesting to me would be able to use, a tokenized treasury in various forms in DeFi. Right now, the actual user experience to hold a tokenized treasury is terrible. No offense, but I can't do anything with it. I can look at my securitized account balance, and that's it. But if I could borrow against it, if I could readily swap it, if I could be a market maker and get a get some yield from the volume that comes through the pool, that would be amazing. And it's at the low end of the risk curve, so frankly, it's not much different than a stable coin. When you get down to the root of it, stable coins are slowly becoming the world's checking account. I think US Treasuries could become the world's savings account. And I think that'd be a really actionable and interesting thing to see.
That would be.
Another theme that comes up pretty often is thinking about a, quote, level playing field around regulatory obligations with TradFi on one hand and then emerging technologies on the other. Una, that it's a broad topic, but what do you think is important for the commission to keep in mind, whether on a pilot, a sandbox, or otherwise? Over to you.
Sure. I mean, I think the important themes are investor trust, market acceptance, and keeping the benefits that we currently have and translating that into, this new technology in terms of how it's integrated into our U.S. markets. And I think it's also important to just take a step back and think about the U.S. public markets as really the primary access point for Americans to be able to take advantage of the economic growth, whether it's for building financial security or planning for retirement or paying for college, and building generational wealth both as individual families and as a nation as a whole. And we've also talked about the perspectives of corporate issuers in terms of making sure that there is a clear set of rules and obligations and rights that they have by accessing the capital markets, and also just taking on those responsibilities as a public market in the U.S. economy. So I think that's an important piece. And in that context, the Congress has empowered the Commission to promote fair competition. And so my own personal interpretation is that you treat like assets alike, and you treat market participants who are performing the similar functions in the same way. So as we sort of think about all the topics that we've discussed today, and it's probably helpful to think about not just intermediaries or the parties in question, but what is the purpose that we serve within the financial ecosystem. And we should think about what are the risks embedded like time delay risks versus economic costs associated with different sort of processes versus speed, efficiencies, and how those might also have risks embedded in them, and just sort of figuring out what those are to make sure that those standards and the rules that are applied to all of the market participants are consistent, with the understanding of what the embedded risks are, as well as the sort of the more obvious ones.
Yeah, I couldn't echo more how important the financial markets are in the United States and how impressive and robust the U.S. markets are in the world. I would echo, I think, what Commissioner Peirce mentioned in her in advocating for the sandbox, or in the sense where standing still is falling behind when technological innovation is moving very quickly. And so we need to, with care and creativity, look to foster innovation and leverage and utilize the best technology that we have. I think there's many ways to skin a cat, and so we should not be beholden to using a pair of scissors just because we've used them over the years. If there's an automatic razor, we should use that because I'm sure the cat's been nicked many, many times. And so I think we should kind of internalize the fact that just because we've done something through convention doesn't mean it's the best way that things have been done. I mean, and there's numerous instances where we've had instances where the system has bent but not broken, and we shouldn't then say we have reached, Fukuyama or whatever is great in saying we're at the end of history. We're not at the end of history. We're continuing to innovate, and utilizing this technology can allow for that. And the amount of capital that's locked up for settlement risks and the amount of capital that's not able to be freely deployed is just immense. And so I think I welcome the opportunity for innovation and experimentation, because I think we can move things forward. And the fact that fractionalization and 24/7 are things where crypto markets have kind of tried to influence the traditional markets, they're not good fits. where they are good fits are in the markets where they were created, where, you know, things go out 6 to 10 to 12 decimal points, and the markets operate in a 24/7 basis. And so we shouldn't be beholden to the past. We should look to the future, but that doesn't mean we do away with everything. We want to make sure they can all work together.
Robbie?
Jeff, I think on this question of level playing field, there's an important principle that we not lose sight of here, which is that we not fall into the trap of incumbents attempting to hamstring new technology players by the same potentially obsolete or due for modernization regulations that they face, as opposed to leaning into the new opportunities created by the novel technology. I think one very natural example of this is that banks to date, for instance, had not been able to engage on public blockchains. And while we advocate a technology neutral approach between public and private, it's become very clear that the vast majority of traction and utility in this space is on public blockchains. And now, fortunately, there does seem to be an opportunity for banks to be unhamstrung in that way and to be able to take advantage in the same way that the new technology entrants in this place have been. Just one other clarification on Johnny, on the point around tokenized treasuries and treasury funds today. We can actually now, for the first time, deliver those on a peer-to-peer basis in secondary market liquidity and pledge them as collateral, including in our case with our fund with 𝐂𝐡𝐚𝐫𝐿, although that's relatively recent, so I understand that.
Well, we are
Superstate also does that, FYI.
We are at 3:30 exactly, so I want to thank the panelists, very thoughtful, very constructive. Thanks for traveling to Washington, and please join me in giving them a hand.
Thank you, Jeff.
So they take a half an hour break here, and then they come back from, I don't know, like 4 till 6 or something like that. I feel like a lot of us are falling asleep. I don't think we're going to cover the second half of this. I know, what a shame, what a shame. I need to actually eat that food, but I do appreciate everyone coming today, showing up. We have apparently 𝐒𝐴 on Thursday morning. I didn't know that. We'll be live again Wednesday for sure, maybe even tomorrow if things get really interesting. I love you guys. Make sure you've liked and subscribed. Check out joincrowncrypto.com. You can get a free week trial in our new group. Jump in our Discord, discord.gg/TomCrown. It's free. It's a great place to be. I love you guys. I love covering these with you. We have a good time even when it's boring.